window, we're looking for where is it obvious that it's left smooth highs or smooth lows. In this case, it's smooth highs. Why? Because overnight, we only saw market go down. So whatever discipline you have, whether you're using market profile, whether you're using footprint, Elliott wave, if you're looking for pitchforks, if you're looking for moving average crossovers and then trading in that direction, whatever it is, okay? If you look for what price has done overnight and then look for the smooth highs or lows in that range, you're going to have pre-session or the first hour of trading's point of interest for index futures trading. And I just laid something in your hands that in without a doubt, there's going to be dozens of guys coming there. Dude, we all know this. Okay, show me your last 20 trading days where you used the information. Okay, when you see these people say it's always been there, ask them to show you the receipts where they used the logic and they made money with it, whether it's demo, okay, or real money. It's cancel culture time on goobers, okay? We are not tolerating the opinions of others that have no evidence, no receipts. Because if stuff always existed, there's people using it with that logic in its own terms, and it's not rebranded. It's not used anywhere else. I'm giving you a whole different perspective. I've already disrupted the entire industry, and we're going to do it even worse this year. I'm going to rattle everybody. But you have to have a framework. You have to know why price should be considering your level of interest. Why is the fair value gap of any importance? Displacement is where we take out a short-term high. Boom. If we take out a low, here, that low, this is a noteworthy sell side imbalance, buy side inefficiency. But let's assume for a moment, let's say you're bullish and you think that NQ could continuously go higher, but you have this. What do you do with that information? Do you try to short it there? No. You look for it to act as what? Inversion fair value gap. So then you would frame it and put the levels on it from the high, upper quadrant, midpoint, lower quadrant, and the low, and then you would study, and does price give you evidence that it's using it? Is it supporting that idea? If it's in a consolidation like this, it's less likely to give it to you because we're in a holding pattern right now. Because why? Why is it just sitting right here like this? Because the session, 7 o'clock to 9 o'clock in the morning, has already done its initial job, which is run to overnight highs that were clear, they were obvious. Retail seen it as resistance. They trust it, and it's going to run for the liquidity that's left up there. And that's where you get that run here. So it's not that it's an engulfing candle, okay? Because this candlestick here, one right before it, has no bearing on what I'm looking at. I'm looking at this structure there. Low, high. This short-term high here was pierced with that high. And then this low and this low, relative equal, had it pierced there. This high, that low, and we're at 7 o'clock. What do we do next? Well, am I interested in seeing this low get taken out? No, because the smooth high is up here at Asian session buy side liquidity. That was what we showed on the start of the stream before commentary began. That's these highs here. And this one here is the trap. This is what throws off people. They're like, look at that, man. It couldn't even get up there. So this is strong resistance. I love that because what is this really the way I teach? They're relative equal highs. And it's high probability because the one to the right is lower than that one. That's the trap. That's the retail trap. That is the thing that you're looking for. Okay. You want to see that type of thing set up leading into 7 a.m. because then you'll have always something to do, whether you're practicing reading the tape or you're not really doing even a demo account entry or nothing like that. You're just watching and observing. And by having the stream started and it had like 12, 15, 12 handles before it ran up and took out these levels. The confidence that it yields to you by doing it, it helps with you knowing what you're looking for. And then it communicates to your subconscious that doing these subtle things doesn't require a whole lot of acrobatics. It doesn't require a whole lot of thought process. They're very simple things. This is very simple logic. You are looking for a framework of time and you're looking for where is it smooth? Where is it like obvious that it is respecting some specific price level? And wherever your eye jumps to where it's smooth, that's many times what you'll see the pre-market session, 7 o'clock to 9 o'clock in the morning, run to. Now, let's play devil's advocate for a moment. And let's assume that all this smooth price action up here, say that didn't get ran to, and it came down and it traded down into this first presented fair value gap from January 2nd. I would expect 9:30. I'm not saying this right now, so please don't take this out as a sound bite and say, see, he said. I'm saying by contrast, if this hadn't ran up there as it has already done, then any drop down would be viewed as a Judas swing during the 9:30 opening to 10 o'clock opening range, that 30-minute window. And then I would look for displacement to the upside. And if it was done on the basis of the first presented fair value gap, then I would use that there and then run up to that. And that's how I would use that during the first hour of trading. See the difference? Okay, so having scenarios, and I'm talking in hypothetical because what I'm describing has already happened here. So I wouldn't expect that type of thing because it already ran for that liquidity. So what you're looking for is now inside of the 2 a.m. to 7 a.m. That is your pre-market session, but including overnight London session. So you look back through that range of time between that and that vertical line. Where in that range between these two vertical lines, where is there anything that's smooth? We've already taken out the high overnight here. We've already cleaned up and purged the Asian session highs. Does that mean it's going to drop and go lower? It could, but I'm trying to kind of like cultivate that idea that who's made money right now? London low, bulls. So between that low and what we have seen here as a high, go back through with your eye and look for relative equal lows. I like this. It's a nice block of price action there. And then I like this area here. And it's also the consequent encroachment of first presented fair value gap of January 2nd. And the further we get down, because I'm admittedly, I'm still bullish on the daily chart. We can see objectives to reach for. Now, just because we have a level that we anticipate that may act as a draw on liquidity because it's a relative equal high or relative equal low, don't marry the idea. If you're brand new and you're learning how to do this, be aware that that might not be accurate for the session that you're watching. It may use it later on. For instance, like London here, you may have looked at this area here and said, look at this is first presented fair value gap. It's 2 a.m. Let's trade it and then reach for these smooth highs. And it just falls short. The reason why that I teach partials because this type of thing here can happen where there's a high, it runs above it, but your objective doesn't get met until a later time. And if you're buying that fair value gap there, you can't weather that type of retracement, which is why we use stop losses, which is why I teach you to tape read before you even demo trade. Okay. These things have to be learned in a graduated fashion. It can't be done overnight. There's no fast track to being able to do this. There's no fast track to making money in anything. There is no fast track. And anybody that sells you that illusion, that dream, okay, they're rooking your impatience and your greed. And I'm not getting anything from you. I'm not asking you for anything. You don't have to watch my stream. You don't have to watch my videos. Just look at my Twitter. I say these things all the time, and it's for free. I don't monetize anything over there. I don't need anything from you. Okay. Don't come back to my channel. It's simple. I don't live off of that. So by having some rule based ideas, it helps provide you a structure mentally and psychologically that I'm only looking for a very specific thing in the beginning. And I'm going to measure the continuity and consistency. Does these things tend to repeat? But if you don't know what you're framing in terms of time, you won't understand where the liquidity is presently. You don't need Bookmap. You don't need all these bubbles all over your chart, which I don't understand that. Okay, to me, that that gives me anxiety. Okay, these things that they have all these little bubbles all over. Okay, there's no advantage in that. That's something you're worried about the size of a bubble or all these types of visual representations when the open, high, low, and close is everything that the market's referring to. The market's not concerned about a bubble or how big that bubble is. Now I'm gonna kill Bookmap today. Okay. No offense, guys. Okay. But I'm just telling you before I say it, if it existed when I first started in 1992, I would have used it. I would have used it and I would have championed it. I would have said, this is what I'm using to help me understand liquidity. But if you're using it right now or you've considered using it, I want to kind of show you how you can see better visually with what I'm showing you here today without no requirement of additional apps that you have to pay for. You don't need to do those things. Okay. By framing the references in time, the kill zones and the session highs and session lows and relative equal highs and relative equal lows, you will know where the bigger bubbles are going to be at. You don't need those types of things. And what is an example of that? Well, we have smooth highs over here. That high that failed to breach it. So there's going to be a lot of liquidity sitting there because new positions were entered there. And existing stops here moved down to that high on shorts. So that logic tells me that this is a larger pool of liquidity. It's much more impactful and it's going to be a stronger draw. And it just so happens to be just shy of that level there. So if it's going to take out that high, it's going to definitely come back up here and sweep that out. And it's a relative equal high because of the definition I give it, which is it gives you a run to a level, it falls short of it, and then it gives you this little red herring run. Man, I love that. I love that because they're so easy to see very simple little runs like this bread and butter setup in here. This is not the first one that's fair value gap. That is. So when you're watching the 9:30 to 10 o'clock in the morning, I'm looking for the obvious displacement fair value gap. Like if it, another rule of, general rule of thumb, if it's less than 10 handles in NQ, chances are you already 80% likely that that's not the first presented fair value gap. Now I'll say it again because everybody went right over your head. If it's less than 10 handles, chances are I'm not using that as first presented fair value gap. I'm waiting for another fair value gap to form. That's why sometimes you've seen in my examples, why did you use that one there and not that? Now you know. See, it's dripped out because everybody's writing books on Amazon and using AI for my videos, and they're putting my stuff out there like that. Well, I never thought about that. Now here's dozens more coming. Okay, that's fine. You keep pushing my name out there because when my books drop, more people will know about it. But the point is you don't need to buy my books because I'm doing this for free here. But if you want the tome or tomes in text, obviously you'll have it. But knowing what you're looking for, where to frame it, on what basis, first on time, it's crucial. It's important to know what you're looking for and where you're going to find it. And that's what I'm showing you here today. So real quick, let me take all this vertical line stuff off. So on your own charts and in your own journal, show that in there and mark it all up. So can you see this diagonal business here? See that right there? In my mind, I see that as retail traders drawing a line from that low up through these lows, up into here, and they see that as diagonal support. In my mind, I think to myself, well, we ran straight from the low at London low to where we went to the liquidity here. And if this is being shown visually where a trend line could exist there and it looks like textbook, then I look at, okay, they might utilize that in the opening range or in the first hour trading. So then I would look for some setup going forward that would yield a disruption to that potential. Well, let me just draw it so we can see what I'm talking about. I am not a trend line trader, but I teach the idea of phantom trend lines. So I see this and I'm like, okay, where's the midpoint? That's this liquidity right there. So I would like to see if this doesn't get disrupted before 9:30 opening bell. That to me is an area that liquidity right there is interesting. Why? Because retail sees this as support. The midpoint of that, and I teach this on my paid mentorship content that's already on my YouTube channel. Just go through 2016, 2017 ICT mentorship. They're all lectures there. They were all taught back then, and this stuff still works today. It worked before I taught it in the paid mentorship. It's just perfect. It's perfect logic. It goes after the less informed crowd. And diagonal support and resistance, again, Tori, I love you. I'm not trying to beat you up. It's not meant to upset you or anyone that believes what you do. I just personally look at that and say, I'm going to attack that at the right times. Okay, if it's there and everything is yielding a setup that would go against this logic, that's what I'll do. But it helps me frame pools of liquidity that are just real easy bread and butter type setups. All right, so let's zoom out real quick and go out to a daily chart and get a feel for what it's doing here. So you can see we're inside this range there. And on the daily chart, I mentioned this. I don't know. I don't know what day I told you, but it's in tweets. I don't know where I actually said it, what date was. But these highs here are real smooth, and I'm looking at that as a higher time frame, macro time frame, daily. This is where I think ultimately it's going to try to get to. Will it get there today? Will it get there without coming lower than it has here? I don't know. I'm not trying to predict that because we're inside this first month, first couple weeks of trading where I don't really go out there and try to push the button and do any of that stuff because it's like the Asian session or the accumulation phase of the yearly candle. I'm not trying to get in here and get positioned so fast. I'm not impatient, which is why I wait until the first Tuesday of every February. I'm not trying to do anything that's going to take on risk because I want to see what are they laying down as a trap? What are they drawing into? How are they behaving? Is price action smooth? Is it coming out the gate at the beginning of the year real aggressive and ranges are clean? There's no difficulty for prices to run to liquidity and it's leaving nice obvious inefficiencies and it's coming right back to it and it's respecting time. See how I just said a whole lot of stuff. If you're brand new to me, that means nothing to you. But someone that's been with me for a little bit of time, and they know my vocabulary, my definitions, the logic of which I teach, price action follows, then you can fully understand why I'm sitting on my hands because I don't want to rush out there just because now we have a new year. It's a New Year's resolution. I'm going to make money in trading. Okay. Just because it's a new year and just because you want to start trading and the markets are available and they're trading doesn't mean that you should be plopping yourself down in front of these screens and start gambling. You have to know what you're doing, when you're going to do it, and why you're going to do it. And there has to be some structure behind it. So anyway, that big green box is this here. So I want to kind of like show you an answer to, I get this question so many times. Please, ICT, please, your chart looks different to mine. Mine doesn't have that volume imbalance. Mine doesn't have that gap. When do you use the set down here? Okay. See how I have this highlighted? The volume imbalance is not shown. When I toggle it, it appears. See that? So when I'm watching price action, I've said this before, I'm toggling on and off every time I refer to the daily chart because I want to see like that volume imbalance right there disappeared. Ah. But that to me, okay, is hidden information if you have this setting toggled on or toggled off. I don't care about the opinions of people saying, don't have it on, have it off all the time. I don't care about those individuals. Okay. You're going to have your own logic. Everybody out there trades with their own interpretations. Okay. Whether you make money or lose, I don't care. They believe in the moon phases. They believe in astrology. Oh, Sagittarius is doing this and Jupiter's in retrograde. And that means, pork bellies that don't trade on contracts anymore are going to come back and now we're going to be able to corner the market in bacon. None of that's real logic. But people with gout and tennis elbow think that the market's bullish too. So if you look at the chart and you toggle it on and off, it gives you visual representations where these gaps or inefficiencies exist. Otherwise, I don't care about having the setting on or off. That's the only interest I have. So I look at price action just sitting here. I'll listen to some music and I'll go through my charts and I'll toggle it on and off. And I'll do the same thing with ES and I'll do the same thing with the Dow. And where the inefficiencies appear by toggling on and off, now watch, look at this candle and go right back to this one here. We're only going to look at that. Okay. Just looking at that. Do you see any major discrepancies? Not so much. Go back through this high to that low. See any major discrepancies? Not so much. Now, this high down to that low right there. What's jumping off? That inefficiency down here, which is why I taught you and showed you in advance that there's the suspension block. It has a volume imbalance at the low, buy side imbalance, sell side inefficiency, and then the high of it has a volume imbalance. But that volume imbalance, if you have your setting toggled wrong on your daily chart, you won't see it. Okay. So that's all I'm doing. There's no mystery to it. It's that simple. I'm just toggling it on and off, and I'm going back through price action in the range that we're inside of, which is that being defined by that low and that high. Everything has stayed inside of that range since then. So I'm looking back, where's the inefficiencies? In every smaller price range, I'm looking for inefficiencies, volume imbalance specifically. Okay. That's what I'm looking for. I'm looking for the close and the opens. Where are they at? Because they change a little bit. Okay. You see them, they change slightly different. That closing price is not going to be the same whether this is toggled on or off. It's going to be a discrepancy there. All right. So I'm already over the boundaries I told you I'd be at, but you know how I go. So here's a 1-minute chart on NASDAQ. And you can see, since we hit that liquidity, that was Asian session buy side liquidity, what has it been doing? It's in a holding pattern. Okay. What is this low in that low? Here to there. That's a relative equal low. Now, if it wants to dive down in there and disrupt that, that liquidity is the one I'd be looking for. But caveat, that low has a wick, or in this case, a shadow, okay, or tail. This little bit of business here, you want to make sure that you grade. I'm not going to do it with mine, but you want to grade that lower quadrant, consequent encroachment, upper quadrant. And if it takes out that low, it could only just go down inside this wick to the lower quadrant or the consequent encroachment of it. So not every relative equal low or relative equal high is the same. If your anchor point that starts the determination whether it's a relative equal high or a relative equal low, that means the furthest one to the left. Okay. This is a swing low. This is a swing low. If you're referring to that as the beginning point of defining your relative equal low, if that low has a wick, you got to grade it. Because if you're wrong, chances are it's only going to go down into upper quadrant, consequent encroachment, or lower quadrant, and then reject on you and go the other direction. That's kind of like where you're going to fail because you're going to expect that to be taken out, and it won't. It'll just trade into that range, and then that'll be the end of it. I mean, it'll go the other direction. Same thing here. You have relative equal highs here. Closest one to market price here has got to be rather lower than the one you're anchoring to. Anchor point is point number one, the higher of the relative equal highs, and anchor point to the relative equal lows is the lower one. If that low or high has a wick, if it has a wick, you have to grade that. And if you're in a trade, or if you're paper trading, or if you're tape reading and you're looking for it to run to that and go higher, always, always, without fail, never, ever, ever not do this. You have to take some kind of a partial. I like to use anywhere between the lower quadrant and consequent encroachment. So split that in half, and that's usually I'm trying to take a partial there. That way, I don't have to have the high taken out. It doesn't need to do that. And it doesn't need to trade through consequent encroachment, because if it fails, consequent encroachment is going to tell you the information that you're looking for if it's going to fail. Because if it stops short of consequent encroachment and it doesn't even touch it when it runs up, that's indicating what? Weakness. It can't even breach the consequent encroachment midpoint of that wick. So if it's going to go the other direction, that's usually indicative of what you're seeing when there's a wick in the relative equal high and relative equal low. And you see how I just explained that in a way that there's no way that I could have done it satisfactory, in my own opinion, doing that in a book. It doesn't communicate the same. At least for me, it doesn't. So I know a lot of you be like, see, that's why you shouldn't just do it. Just do everything in video. I do. It's why it's here. It's on my YouTube channel. That's why I said don't buy my books. But for the folks that do end up just buying the book, okay, you're going to look at these examples and be like, it doesn't feel the same. I don't feel like I understand it. It's because you have seen me teach dynamically over price action and seeing it deliver with examples, talking about it in X and talking about it in live streams. And when you were behind a paywall, you watched me talk about it all the time, every single day. It was panning out, panning out, panning out. So while books are wonderful and I love books, there's only so far a book can take you when it's very technical, like trading is, and reading price action. So, these are the types of examples that I hopefully bridge that gap between what I'm aiming for when I'm discussing it in print versus showing you to in the chart where it's likely to perform and what it's likely not to do and how it will behave. So, the next bit of business in the morning, what I do is I go to regular trading hours and I highlight previous settlement regular trading hours. Okay, that's this price right there. So if you look up here, upper left-hand corner where I'm showing my mouse, that closing price, 25,933 half. Okay, well, I put a line there. We'll just use some manly color purple, and then we'll watch what I'm labeling. Okay, regular trading hours, opening range gap, and I'm going to just put high in here now, and I'm going to look at where we are and where we're trading at. It's 7 minutes after 9. Already you're thinking I'm going to be doing the whole session right now. If you're thinking that, you're wrong. Not to hurt your feelings, okay, but I just went a little bit further on because you know how it is. All right, so middle in the right, so that way it's going to highlight over here, and then that's a little too much. So we'll just, there it is. Okay, so now that is regular trading hours, opening range gap. It's not the high or low yet. I don't know that yet until I go back into electronic trading hours. So we are significantly higher than that. Scrub down. I'll lose it. Oh, man, eyes. 25,933, and let me make sure I have this showing on. Yeah, the width is 4. 25,933 half. 933 half. Yeah, we're significantly higher than market price. That's up here. So it is relative to the opening range. It's going to be the high because where we're at here, it's not likely to trade from here unless, obviously something crazy happens in the world. But that likelihood of closing that out between 9:30 opening and where we are at now, not likely at all. So regular trading hours, opening range gap high, and then you can copy that by tapping it, hold down control and drag it away. You can copy it like that. And then you can put it in close proximity where price is at and then wait for the 9:30 opening and then drop this on, but have it show below. And then once you have that, then you can drop your fib from the opening price at 9:30 up to 25,933 half, and then you can grade that opening range gap. That's the regular trading hours opening range gap. Okay, it's not new day gap. Or, I'm sorry, new day opening gap or new week opening gap. It's just the difference between previous day settlement and regular trading hours to the regular trading hours starting. So Friday's settlement, regular trading hours, to Monday's regular trading hours opening, which is 9:30 Eastern time. Okay. So it's a huge gap there. And right away, what do you think is likely? It's going to want to explore up into that, right? And what else do we have up there? This week's new week opening gap. You're probably looking at that thinking, what is this? I'll get to it in a second. And we have first percent of fair value gap from January 7th. The new week opening gap for this week. And we have regular trading hours opening range gap all the way up to essentially the low of this week's new week opening gap. So having these levels, if you, again, that's my little notebook. I have these levels just in numeric format. They're stacked in the order of highest to lowest, and there's little sign, little shorthand notes telling me what they are. Just the same thing I'm showing you here. So there's nothing that I'm willing to show you, let's put it that way, publicly, that's on my notepad beyond that. This is the only things that you need to have on your chart. Old data. I'm not even using the opening range from Friday. I'm not using the opening range from Thursday. Okay. These levels are just salient to me because they're impactful and they go back a full week. So last Monday's trading to now. So I'm looking at 5 trading days back, not counting today. Go back and you have a whole week of trading. And these are the most salient PD arrays that I'm interested in, my interest. It doesn't mean that if you have something else in your charts that that's somehow less important. No, you have to take these concepts that I've taught you and make them your own. What are you going to focus on? There's no inherent wrong way of applying what you're looking for, especially when you're in these lower time frame charts, because there's all kinds of opportunities. But knowing when the market's going to draw to them and what you're framing it on, the highest probability is what I've shown here today, where you're looking at the time aspect first, relative equal highs, relative equal lows. What happens if you go back through price action and there's no smooth highs or smooth lows like we have over here in Asia? Like, say these didn't exist here, okay? Say this wasn't so smooth. Say it was just this high, and this was just a continuation lower and didn't create this obvious where your eye jumps right to it. Then this high here, that would be a single high liquidity where that would be overnight highs. That's where I would aim for. But because these are smooth, If it's going to go here, how far can it go? It's going to clear up and disrupt this smooth area over here and make it jagged. And I think everybody watching could see that that was made jagged. And it's being held in that holding pattern I told you. It's being held. Why? Number one, there's no news. Two, it's ahead of CPI tomorrow and PPI on Wednesday. So there's a lot of reservation on the part of speculators. So there's no interest in the market running, aggressively either way because it knows who's it or what is it. The market makers know there isn't going to be a lot of participation. So even if it does keep printing higher prices, because that's what it's doing, it's not buying pressure. It's just going to keep offering the price higher, higher, higher. It knows that market orders are going to come in and it's going to print and allow your chart to populate and show that price level. It's not likely to do that because the volume of big, deep pockets coming into the price behind it that they can later on utilize as counterparty. That's the real market making. Okay, don't listen to Einstein on the floor. Okay, he's doing nothing different than you and I. He's looking at price and guessing. That's what that is. Okay, so when he says that nobody's trying to do your liquidity sweep or your stop rate or whatever, that's exactly what's going on. That's exactly what's going on. So if you have, go watch Pax Trader or listen to him. He was down here. He's the biggest guy in the Nasdaq pit. And he was telling you stories that he was watching another house try to run him out. But then you hear Einstein say it doesn't happen. Come on, man. You got to consider who you're listening to, okay? So give me 1 second here. Got to let my son, he's coming in late. Anyway, um, having an expectation of the market not really wanting to run aggressively one way or the other because they won't entice the participation. Okay, it doesn't matter how many contracts are traded. If the algorithm or market makers want price to go to a specific level, they will continuously keep offering it in one direction. That's the reality of it. It's not buying and selling pressure. You're just going to see whoever is getting filled at those market prices as prices being continuously offered higher, 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 or in deference to when they want it lower, when it's going lower. Okay, so try not to concern yourself so much with volume because volume is not pushing price. It is not. It's just reflecting yesterday's news. Where did people get filled and how many got involved in that move? Has absolutely no bearing at all on what's really pushing price. Because what's pushing price is the intended outcome that those in power that control price, that's what they want. That's what they want. And by you seeing the reflections of price action over the lens of volume, how many people bought or sold at a particular price, I don't care. That's like saying, how many people bought the car that I like yesterday? How many bought? How many people bought the new Zora Corvette? I'm going to base my purchase on how many people bought the Zora Corvette. That's 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 important to me. That's not important to me as a trader. I want to know what I'm looking to see trade to. Notice the difference there? Volume is looking at what already happened. I'm teaching you where the liquidity is it's going to draw to. That's not reacting to anything. That's anticipation. I'm teaching you to look at inefficiencies that are in price action that are not hiding from you. And I'm telling you where they're going to form before your low volume nodes even come into existence. No advantage, like I said. So the point is knowing what you're looking for in terms of time, look back. How far are you going to consider your range? Why are you considering that range? Because all of the activity, the sentiment that was inside of London, Asia, and the same thing is done for the New York session. So in New York session trading, you would use the 9:30 opening to 4 o'clock close Eastern time. So if you're going to be an Asian trader, or if you're going to be a London trader, that's your information you would use overnight or during those hours. Look for the smooth highs and smooth lows, or look for singular highs and singular lows that were very dynamic, like we explained here. Okay. So anyway, how you feeling today, Caleb?
I'm doing quite well. A little tired, but I'm here.
And you're late.
I am.
So he will get the paddle board and put some towels on his face and pour some bottles of water over top of him and see if he can hold his breath.
Mm-hmm.
Training.
Mhm.
All right, so that's the real train. Y'all want to come here and train with me, but that's what we got to go through. We go through, hanging you by your thumbs and your big toes, and learn how to trade upside down. Because everything in retail, we want to be diametrically opposed, and that's how I train my sons. Anyway, the point is this: we've seen the market run to the liquidity that was outlined at the beginning of the stream. I didn't need to talk about it because it was right there on your screen. The prices ran up. Okay, we talked about how relative equal highs and relative equal lows are a factor in price delivery. It matters not the volume. I don't care how many people bought. I've never considered how many people traded at a particular price level. I don't care. I don't care how many orders were filled above the Asian session buy side liquidity level that I've highlighted here. I don't care. It doesn't matter if one contract printed at that price level or 5,000. I don't care. I don't care about that because I'm looking at what price is going to do next, not what did it do and how many people participated in it. I don't care about that. I don't care. Look at your book map, okay? Look at your level 2 data and look for these big orders. I can show you find a live streamer that's doing this, okay? I'm not trying to beat anyone up, okay? But send me a link in X where some guy or gal is using that type of information and they're saying price is going to go to that level because look at that number right there. Okay. And I will diametrically execute against everything that they're doing. And I'll prove the point that that is not advantage. And I will use what I'm teaching here. Okay. I'm telling you in 2026, I'm going to wreck everything you think you know. Everything you think you know. Okay. I'm not coming for any one person. I'm coming for everyone. I'm going to roll over everyone. Okay. Everything that you think you've learned in price is flawed. It's a lie. It's a myth. Okay. Volume is not the secret. That's yesterday's headline news. This is how many people traded. This is the volume of trades. It's the same thing as watching the news at 6 o'clock and they say, okay, NASDAQ was up, blah, blah, blah. And this is how many shares traded that day. Wonderful. How are you going to make money off of that? You can't go back in time and get in that same price. You can't do it. And just because you have a volume, shelf high and low, and a point of control, my first presented fair value gap is the real control. Me teaching you, showing you where the session high and kill zone high and low, buy side and sell side liquidity, that is the real high and lows that it's going to draw to. That's the benefit of knowing what I'm teaching. It's not borrowing logic from anything else. It's just focusing on time first so that way you can frame what it is you're hunting. I live in an area where there's a lot of deer all the time. They're always migrating around, looking, look out the window any time of the day and you're going to find one. Well, there's areas up here where if you're driving through and there's a lot of farmland and whatnot, and you'll see these little tripods out there towards the edge of the forest, and they're feeders. And what these things do, they drop down pellets and whatnot to feed these deer to keep them coming back to eat there. So that way the hunter can eventually come back with his stand, set up his little hide, and then wait for this deer so he can ambush them. Okay, so what has he done? He's mapped out, he's framed out his kill zone. He's not going to go treading through the forest and the woods looking for a deer. He knows that this is what it is. Well, when I look at these pools of liquidity, session highs and session lows, inefficiencies inside of that, their setups, their draws too. But I'm looking for relative equal highs, relative equal lows in deference to the session entirely and the kill zone. It's not just the kill zone. It's not that. So if you go back through The whole entirety of session start at Asia. Let me put just for a second here. Let me put the lines on because Caleb just got here and he's missed it. Okay, so there's Asia session start at 7 p.m. last night. From this point all the way down to this low during London, right before 4 a.m., there are highs and lows in here, okay, that can be used for fair value gaps. That's not my first interest. I'm looking at where in that range from that low all the way up to the highest high of Asia, I'm looking for where is it smooth? And it's not as easy doing it this way versus when you crunch up your chart. Look how much more clear you can see how that's very, very smooth versus anything else in that range. You see what I just did there? And when you watch these folks and they're streaming and they have their charts like that, like you're literally you have your nose to a tree and you're trying to see the forest. You can't see anything. You have to zoom out. Like you have to get a broader perspective. And by zooming out, it gives you a perspective that helps you quickly, without any doubt, where is the smooth edges that will be made jagged. And you do it by compression on all your ranges. See that? So you can see clearly that there's a smooth level. There really isn't any, well, that kind of is right there to me. I like that one. But this one is obvious. And it's about, it's in the lower half of the range defined by 7 p.m. last night, start of Asia session, to 5 a.m. when they close. All this business dropping down, relative equal highs, start at 7 o'clock in the morning. It's going to run and upset that distribution of shorts. They're protecting that with their buy stops. So that's buy side liquidity. And because there's no news, we're in a holding pattern. Look at prices done. Say you want to do, I was aiming for that, but it's jumping around. There you go. Say that is what you're looking for if you're a trend line guy or gal. Okay. Midpoint is still that low and it drew down into that. Same thing here. Diagonal support, midpoint is here. So that liquidity drew down to here. We're back down into old lows, inefficiency, and first presented fair value gap of pre-market session, 7 o'clock to 9 o'clock in the morning. That window is this, Caleb. That right there. So this is all anyone really needs if they're brand new and they're starting. If they just look at the price action just inside that window and look at overnight highs, overnight lows, overnight relative equal highs, overnight relative equal lows. They will be inside of the highest high and lowest low of the session sometimes, just like that Asian session buy side liquidity pool was. It's inside of the entire range that was overnight. So it's not just simply what's the high of Asia. You use that information. It can eventually trade to those levels, but inside of the range overnight, you're looking for where is it smooth? And the probability of it running to them vaults, it increases exponentially if it's part of or around a quadrant level of the entirety of the range. Did that go over your head?
A little bit.
All right, so let's Just for, I gotta get a better trend line here. Same thing. If you use that logic here, midpoint, this is exactly what I teach in my lectures on. I don't recall if Kit was here, he'd tell me the friggin' minute number, the video, the what month, what lesson it was. I have students that are really, really, articulate with keeping records of where I said what I said. But just look for phantom trend lines and the way I use them and teach them and how to attack that specific pool of reference and liquidity. Right. Let's go back to 7 start time. And this is a candlestick it started on, right there. So this is your high, and that is your session low. Okay. I'm going to just for a second remove everything. And we're going to grade that high down to London's low. Okay. So here is midpoint, upper quadrant, lower quadrant. So inside of the lower half, we're seeing that relative equal highs. Okay. You would look at it like this. Go back through that whole range of price action, and you should be able to see how that's very, very smooth. Okay. Until this little business right there, that was smooth too. Either one of them would have been good. But because this one was disrupted, that was left. And then you see this price action here. There it is. So let's go back because we just opened up. Remember, I was saying earlier, we have new week opening gap higher. Let me do this. Boom, boom. Everything's back. Now we put this regular trading hours low on the opening candlestick. Open price right there. Open price is 746 quarter. Okay. 746 quarter, and I got it on 3/4. So let's change that. There it is. All right. And regular trading hours, you'll see that that's a discount gap. It's low. And the previous session, or trading hours close, is up here. So there's the gap. Okay. All that right there is the gap. We go back to electronic trading hours. Disrupted the liquidity I told you it would reach for. Don't take my word for it. Go back and listen to the stream, everything we were looking at. Traded up to and through first presented fair value gap from January 7th. We're inside of the Asian session displacement from January 7th, and I didn't get a chance to show you what that is. Let's just watch this for a couple seconds, okay? And 933 half. 933 half. We'll fix that when it dropped on here. And 746 quarter. All right. So consequent encroachment, opening range gap has been now tagged. So there's your 70% likelihood before 10 a.m. It's done that. Upper quadrant is here at 25,887 even. And I'm showing you eighths. Okay. So don't be confused by that. Just look at the little number here. Like that's an eighth. That's upper quadrant. This is consequent encroachment. So there's this big vacuum, okay, of no price action during regular trading hours between where we settled at 933 and a half up here and where we opened here on that candle. So if think about you have a carbonated soda, okay? All of a sudden you flip the tap on it, and what's going to happen? You're going to hear there's a release. Okay, well that is what's happening right now in the marketplace where there's this big compression inside that range, but it's void of any kind of price action delivered to it at all during regular trading hours. Even though there's a big important thing here. Even though we traded through this area here overnight, and this is Asia session high rate there. Okay, so that's Asian session high. The highest high that that session had is this level right there. So you would have that highlighted. And let's make it black because I want to see it stand out a little bit. Okay. So the only thing they did was came down and disrupt that trend line, like I told you. That was your Judas. No need for it to go down into this business down here. Subtle little retracement and then expansion to the outside. Real aggressive run into old PD arrays. Upper quadrant is here. Asian session high here. And then we have new week opening gap here, all during the same time that we showed on the daily chart that those relative equal highs on the daily chart, they are too smooth on the daily. So it creates this perfect storm where price will want to rush into that space where there's no real trading during regular trading hours. Again, let's go to regular trading hours and take everything off the chart for a second. We started trading down here, that price right there. And that gap goes all the way up to here. So you see how it's rushing back in. Okay, it's rushing back into this unpopulated area of price action. Even though overnight on electronic trading hours, it has already traded in this range. It hasn't traded up here yet, even in electronic trading hours, but it has traded where we're at here. So we're basically overlapping what electronic trading hours has already done. All right, let's go back into electronic trading hours. This candlestick right there, while you were driving here, Caleb, I was discussing how this is pre-market session trading time, 7 o'clock to 9 o'clock in the morning. This is the first presented fair value gap right there. Right here, because it's taking out a high and its displacement above that high. And it's not this little tiny little separation here between this candlestick high and that candlestick's low. That's not the fair value gap. It's breaking through in the direction we already determined that it was a draw. We've laid out several things this morning while you were driving over here. The fact that we're opening low at 9:30, it's going to be a discount opening range gap. The new week opening gaps above us. The relative equal highs are above us on the daily chart. There's several PD arrays that are highlighted here. And there's so much of a vacuum price to want to go back into this area. Then it keys off of the level Dad talked about as the first presented fair value gap over here during the pre-market session hours of 7 o'clock and 9 o'clock in the morning. And yet, watch and see. You will still see people say that none of this was explained beforehand. It's always after the fact in hindsight. When I'm literally doing it live stream, I don't know how many people are watching. What's the numbers on the live stream now? Like 20 people watching?
Probably like 12.
Einstein on a stock exchange floor would never tell you that this is what that was. Yet, these people make lots of money. They make lots of money. They're pillars in the community. You can see them. You recognize them by their faces. You may not even know them by their name. Like I can't even tell you what the guy's name is, but I know if I see a picture of him, you know who I'm talking about. Einstein. He looks like Einstein. He's a floor trader. Um, I'm convinced that they just have to play their role. They just got to not upset the apple cart. They know what's going on. And keeping it hush hush and just playing along with it, like nobody's really trying to run your stop orders. Well, here's Pax. He's off the floor. He was in a live stream with Kit, and I was in there, and he joined in, and he literally said he was having another house, another clearing firm, try to run against his orders. That's a floor trader telling you that. The biggest floor trader in the NASDAQ pit. Who are you going to believe? You're going to believe people that say, there ain't no stop hunts. Nobody's going for your stops. And here's the guy that's the largest one in the pit, and they're trying to muscle his orders. And you don't think they're trying to muscle the existing orders above relative equal highs, relative equal lows, or session highs and session lows? Come on, man. Seriously? I mean, I get it. You know, everybody's a team mentality, but you got to be your own team. All right, so upper quadrant's now been hit. So we have the other remaining portion or last quarter of the gap between regular trading hours session close last week and this upper quadrant level. That does not need to be delivered at all. This right here is enough to prove the things I've outlined this morning, where it was going to go, where's the draw, where's the direction, up, filling in this area, everything going higher, everything reaching towards that level I talked about on the daily chart, those relative equal highs. They were on the daily chart. They were real smooth. You probably didn't see that, Caleb. So let's take everything off for a moment. Go out to the daily chart. This is your chance right now. If you like what you're seeing, like if you're learning anything from this, there's a little free button. It's a thumbs up on it. I promise you, it doesn't make me any more money, but that's like my report card that I use to determine whether or not I'm going to be interested in coming back out here and doing any more of this. So if it's a good number, then obviously that, you know, I'm entertaining you, right? You're learning something. So 26,133.5, that was the level I mentioned, you know, a week or so ago. I don't know where. I said, you know, make sure you have that on there, because on the daily chart, this is a potential draw. Does it mean it goes right there today? Does it go there this week? I don't know. I wouldn't be surprised if they use the CPI and PPI number to run it through that. That's what I would reasonably expect, but it doesn't have to happen that way. I'm just saying that I like the idea of framing the majority of any setups. They should be in that direction. Okay. Even though we're in this big consolidation, this is a likely draw. And in and of itself, by itself today, it's already proved effective in terms of determining direction. So you're sticking to a bias that's derived by the higher time frame daily chart. We literally zeroed in with precision, outlining how retail would be targeted using their, you know, supposed diagonal support ideas. Okay. Not one volume profile thing was even mentioned today. And I gave you so far the low of the morning session, the direction it was going to go in. And you're going to argue this. You're going to say it didn't happen. You're going to come at me and you're going to say something in X that has absolutely no truth to it, but we're all watching it happen. If he failed, he wouldn't show it to you. If he would have lost on the trade, he wouldn't have showed it to you. Well, I'm out here in front of everybody live, explaining why it's going to do what it's going to do, where it's going to do it, and how it's going to do it, and what time it's going to do it. To me, that's somebody worth listening to, and especially if it's for free. Come on now. No upsell. Wow, there's 6,800 people watching me. I'm getting nervous. I'm getting nervous, Caleb. So it's basically ran about 150 handles or so, which is a nice price run. I mean, that's a really decent run. But on the grand scheme of things, it's still minute and small. But if you're on the wrong side of this and you were expecting to go lower, it feels like a mountain of a move because it's steamrolled over top of you. You probably didn't understand where it was going to come from. Everybody watching the stream knew where it was going to come from. And the little boy can say, came for his volume profile. Come on, let's see here. Um, if you consider the factors that we outlined so far today, like you say you were long off the first percent of fair value gap that I outlined at 7 o'clock start of pre-session time. Say you close your trades right here, you're done. You're completely out of the market. You're done. From this point here to where we're at right now, which is upper quadrant of the opening range gap. That's this level right here. Okay. Full closure, the gap is up here. You have already secured the lion's portion of the move and the entirety of the present daily candle from low to high. But yet you're not supposed to know how to time the market. They're going to tell you you can't time the market because nobody can do it with any measure of consistency. I love that. Like, I love that because that presents what? The opportunity to exact revenge on people that oppose what I do. I love it because it gives me the fuel. It gives me the moxie, if you will, to continue doing what I'm doing because I love proving people wrong. Because what I'm trying to do, I'm gifting this to you. I'm not selling it to you. There's no price tag on it, your time. But clearly, find somebody else out there that live streamed today and explained exactly how the market was going to do what you're seeing it doing right here today to the very levels that it delivered from. Go back and watch the stream. If you came in here late, this is it, baby. This is it. You're not finding that in volume profile. You're not finding that in Elliott Wave. You're not finding it in any other borrowed logic. And it's not rebranded anything. It's just simply you learning how these markets are really booking because they're algorithmic. It has absolutely nothing to do with volume. Volume is just a reflection of how many people did something at a particular price. They didn't move price. Volume didn't move it at all. It didn't move it. Period. And you can argue and say whatever you want to say, but they're not giving you any advantage. It's just you simply saying, okay, this is how many people bought or sold at that level. And I'm going to believe if it does trade back to that level, I will make a decision based on that. That's you reacting. You're reacting to that. I'm anticipating. I'm teaching you as a student to anticipate, not react. If you're honestly always simply looking at the chart with the intent of reacting to something, what are you doing? You're trading hypersensitive. You're always looking for something. And since you're in a reactionary mindset, you're going to be more in a position of, like, God bless you. You're also in a position where you're going to probably have your mind or your convictions about what you think is going to happen in price action. It's going to be easy for you to have your mind changed. So you're going to be changing your bias back and forth, up and down, up and down. So being a reactionary, okay, is foolish. You need to anticipate. You must submit to the idea that you are predicting price. Every one of us are doing that. And for the people that try to say that they're not, we're not trying to be right. What they're doing is they're making allowances for their high number of losing trades, their low accuracy, their low delivery of successful trades. That's what they're doing. They're coping with that. That's why they talk the way they do. That's the reason why they talk the way they say. And they come at me and come at you as my students because we don't talk in a defeated mindset. We don't talk about how we're going to react to something. We don't go out in the car when it's done snowed and say, I'm going to see how fast I can go. And then I'm going to react to the sliding that's caused by my own actions versus it's snowing. I have to go somewhere. So I got to get somewhere. But I'm going to drive with sense. I'm not going to go out there and drive faster than I should. And I'm not going to apply the brake abruptly as I would if it was dry concrete. I'm going to slowly work in my stop by taking my foot off the acceleration pedal and then slowly feather the brake. And then you won't ever slide. So what are we doing? We're anticipating. We're anticipating that. Not, I'll react to it if it happens. And what happens when people start sliding? The natural reaction is they're going to react and put the brake on, and it's going to cause the slide to increase. See the difference there? Mindset. And having an anticipatory mindset, we see that there is a likelihood that we could start sliding. We could lose control and traction. So We don't do anything. We wait. And then when it's time for us to do something, it's already based on something that we already expected. So we're predicting, we're not reacting. So now imagine if you didn't take off your trade and you're sitting here like this. Would you feel confident it's going to continue and close over above the Asian session high or have a deeper retracement back down into the 780s? Knowing what you're looking for, also when it delivers a big rush of a price run like this did here, that run, because it was parabolic, it was real quick out the gate, and it's already done 3/4 of the move. That's this right here. 3/4 of the opening range gap between last Friday's closing price to where we opened on the 930 candle. 3/4 of that's already been delivered in a few minutes. Whether you close your entire position or partial, something should have been banked because it can always have a retracement deeper than you're wanting to or willing to hold on to. High, high, high at the upper quadrant. Liquidity resting still at Asian session high. I don't need to know how many orders came in and bought right there. I don't care what the volume is. I told you the level before the market reacted to it. First presentation, nothing is superior to that. Nothing. I don't care who wrote a book about it, how long they lived, who they taught, how much money they made over here in this competition, how many things they're doing in live stream. Precision is precision. I'm going to tell you what time it's going to happen. I'm going to tell you on what candle it's going to react off of, period. When I pointed and walked you to this candlestick, and I told you relative to time, that's the one that matters. That's it. That's the one that matters. Did I have to pull up any kind of volume and how many people bought them create that candlestick? No, because it's not important. What was important? There's your Asian session high. Oh, look at that. Give it up for hindsight, baby. Hindsight. Yeah. Woo, yeah. Welcome to Volume Profile. I'm profiling. Yeah.
Styling and profile.
That's it. That's it. So here we have the high. These guys really narcissistic. I can't watch them. Go somewhere else. So we have a bullish candle here that I don't care how many buyers came in during that candle. I don't care. That candle exists below that low, that low. We tapped into it here, and then right before the opening bell, they snatched all the liquidity, resting below here in the direction that we outlined because of the daily chart, because of the opening range gap. It's going to rush to get up in there, and the new week opening gap for this week. So again, here's where you would want to, if you have any position open still, you would want to take something off here because we have done a run on Asian session high. So overnight highs have been cleared out. That liquidity has been purged. We went to another eighth of the range, not a quarter. Okay, so it's an eighth, and it just got close to new week opening gap low and regular trading hours high, which is Friday's regular trading hour settlement price. And you'll see that again if you toggle to the regular trading hours little tab down here on lower right. All liquidity now is resting on the sell side right below that low. We've taken out highs here. We cleared Asian session high, and we're in striking distance, flirting with a run to full gap closure and a tap into new week opening gap low, which need not be delivered. I was only supposed to be here for an hour, but I'm sure some goobers out there were like, oh,
Well, they know how you are. That's all your stuff is. We're going to talk about this for 30 minutes, and 3 hours later, we're still talking.
it is. All right. So anyway, I covered a couple things that I felt were important factors in doing what you're supposed to be doing in the morning before the trading times. How are we referencing time? What are the contrasts between session and kill zone? What is the importance of that? How are we looking for liquidity? How are we identifying the key levels that's going to operate under the guise of bias and session bias. In other words, what direction are you trying to trade in? And where is price going to key off of? How is it going to react? What is it going to do? Why should it do it? What specific fair value gap? Which one am I looking at? There's your low of the day right there. It ran to the levels that we outlined in advance. Previous session, first presented fair value gaps, grading the opening range gap. We saw it run real quick to consequent encroachment, which is this level here, which is half of the gap. 70% of the time, you're going to see that deliver by 10 o'clock in the morning. So you right away, you have a huge advantage of knowing where that is, and the market will likely gravitate to that. Then, by including other factors like the overnight liquidity by Asian sessions high, can you see how that's not hard? It's a very simple thing. Where was the highest high in 7 o'clock in last night's time and 5 a.m.? Whatever the highest high is, that's the Asian session highs. That's not complicated.
Yeah.
I'm not saying I invented it, but I'm just saying go through the process of knowing what that is and then grade that range. If it's likely to be bullish, as we outlined, and we said we were looking for higher prices, we've been looking for higher prices on NASDAQ. There's a daily chart, relative equal high there. We have a big gap opening that's lower, so we're opening in a discount. We framed the logic on how retail would be using, supposed diagonal support and resistance, okay, and how they're going to target them, and they're going to draw down on that liquidity. And when they hit that, and it's in concert with first presentation of a fair value gap that displaces, it has to move in such a way where it's showing you not only a direction, but it's showing you a magnitude of the move, saying, okay, I'm showing you something, I'm tipping my hand to you, here it is. Like this is me showing you the beginning of the run, and now it's really going to take place. So when it does that, relative to time, 7 o'clock in the morning, everything has to start there. If it's not framed on time first, you're gambling. If it's not framed on time first, you're guessing. If it's not framed on time first, you have a likelihood of being wrong. I'm not teaching you to be right. That's just going to be the derivative. That's going to be the outcome of doing what I'm teaching. And you can't escape the fact that you're being shown this live. Do it live. I can't believe it until you do it live. Don't believe me. Go do something else. Why would you sit and listen to anyone if you have no faith in them? Like, why would you even waste your time? I wouldn't do it. But if you're seeing the things repeat over and over again, and then the times I'm live streaming explaining it to you, the logic, if the markets don't do these things, then my concepts don't work and it's all fraud, right? I would fall on my face. But why is it that the market's literally doing these things and no one else can point to another school of thought or discipline where it has been derived from? Because it doesn't exist. And that's all I'm asking you to do is do your own investigation, do your own analysis, test it in your own hands, see if these things are actually happening. And then you don't have to worry about it. You're not trying to be a cult member. You're not trying to worship me or anyone else. You're trying to find your own way in this. So that way it's got the least resistance to you finding success in it. And that way you know what you're doing. You're not guessing. You're not trying to figure out what do I do here? I'm going to be paralyzed with uncertainty and not knowing because there's no rules of what I'm supposed to be doing. I just showed you a masterclass today of what you're supposed to do every session, every morning. Where do you find the liquidity? How does it look? Where do you find it in the previous sessions? What sessions am I using for the trading session that I'm trading in right now? I did all that today. If you missed it, it's in the recording. It'll be here. I'm going to add it to the 2026 playlist so that way you can go back and find it easily. Anyway, I didn't want to spend this much time this morning, but it was too good not to throw it out there for him. I'm still fasted, so my stomach is, I'm trying to fill it up with water because it's going to be like ground. So now what I'm looking at is if it trades below this low here, there's liquidity here and there's a minor sell side liquidity there. If it's going to run here, I would demand that it wants to go there first and not take out that liquidity. If it takes this liquidity here, I would walk away and be content that the lion's portion of the move for the morning session is done. I wouldn't worry about coming back into the afternoon either, because it's what the economic calendar is driving that decision making. We had a nice tradable run this morning. It reacted off the levels that were given to you live streamed. The logic behind why it's important, what's the factors behind it, why is it salient, what is its usefulness, what direction is the market going to trade in, what time this market will start running. All these things are outlined very specific. They're not ambiguous. They're very scientific, if you will. And if your trading is not based on rules that are that detailed, then you are a reactionary trader. Then you are gambling. You're guessing. And guesswork, I would never put money in a guess. I don't gamble. I don't bet on horse races or football teams and baseball games and sports events and basketball. Who wins and who gets the point spread? Who beats that? That to me, it's all randomness. That's random. I'm looking at time and price, and I have a statistical probability of being correct more times than I'm not. So therefore, I have a measurable probability of doing the same things over and over and over again the way I teach it. The outcome is measurable, and it's usually a positive. See how you strip it down to, is it worth doing or not doing? Is it something that you can do and measure and see and see if there's any efficacy behind it? It's time delivered. It's rule based. It's not ambiguous. It's very specific things. And anyone that says that's otherwise is simply they haven't learned it right. They haven't spent enough time here, or they're just selling something and they just want to be, they want to pretend they're a competitor. There's no competition here. Trust me when I tell you that there's no competition. Anyway, I'm gonna jump off here because I'm hungry. To be honest with you, I'm gonna get something to eat. But I hope you had some insight given to you today. I hope you enjoyed it. I hope you learned something. I hope it inspires you. I hope it gives you reason to go into your charts using the logic that I taught today. That way, this is what it looks like. This is what you're supposed to be looking for. How to determine a bias, where it's going to draw, what liquidity, what relative equal highs am I going to look for? Where do you find them? I went through a lot of stuff in this one today. So this is far better than I could have done just in text form in the books. So hopefully you guys can appreciate that and hopefully you had fun. Until I talk to you next time, I wish you good luck and good trading.